it was last week, Thursday, marking the 30-year anniversary of Black Monday, the single biggest loss in the stock market in history. So local financial planner Scott Carty from Carty Capital Management is joining us today, talking about the anniversary, talking about where things stand today. And it was 8 months ago when President Trump was elected. And I talked to Scott, he was on the show. I said, we've got to be headed towards a downturn. And Scott said, I don't think so. And you know what? He was right. So he knows some stuff, I guess is what I'm trying to say. Scott, talk to us a little bit about what happened 30 years ago today.
Yeah, October 19th, 1987, the Dow dropped 22%, the single greatest loss we've seen. And
what happened? I'm trying to think back, but what caused that?
Well, it really started back in August. The Dow hit 2,700, 2,722, I believe, and then it just started dropping. So really it was a global issue. Things started happening over in Europe and in Asia.
Oh, because there wasn't one particular event that caused the crash.
No,
okay.
It was months of slowly building up and then that one day. And then, but the funny thing is it really wasn't even a down year. The Dow was up 2% for that year. So
even with the crash at 22%?
Even with the crash.
Wow.
So the Dow started at 18 and change and then ended at 1922, somewhere right around there.
What was the response that people had back then?
So it took about 2 years to get back those gains, to get back up to 2,700. But you know, if you stayed calm, if you thought logically instead of emotionally, then you did fine. So the thing is, back then, the baby boomers were the largest generation, and they were all entering the workforce. And that's really what pushed the market from 1,700, like it was in '87, to where we're at today at 23, almost 23.4. That we are. Now, the baby boomers were the largest generation then. They're actually second largest today. The largest is the millennials.
So is that why we're seeing kind of what we're seeing? I mean, we dropped 22% back in 1987, but this year we're up 15%. Yeah. So are you saying that it's the millennials, it's the baby boomers moving out, millennials moving in that's causing the market to rise again?
I think that's part of it. I think you're seeing the two largest generations on both sides of the spectrum really pushing the economy, but the economy's just doing really well. So I think that is part of it. You know, the Dow's up 15% for the year, so if you invested $10,000 at the beginning of the year in the Dow, you'd be up $1,500.
What about, people get so fearful about investing in stocks. So what is your advice? And is it a good time to invest? I mean, everything is up here right now.
Right.
So it's not a great time to be buying into the market, is it?
Or is it?
Or is it?
It depends. Really, you kind of want to look at, you really want to be able to custom plan towards you, okay? Warren Buffett says you take your age and subtract that from 100. And that's the maximum amount of risk you want to take in the stock market. Okay, so for somebody like Derek, he could probably take a lot of risk because he's a little bit.
So wait, if you're 50,
as a percentage.
As a percentage.
That's
yes,
how much risk you want to take. Okay.
What's
Does
that
make
mean?
Sense?
No.
Okay. So
does it make sense to
I'm
you?
37. Okay. So I probably want to take what is that? 63%.
Sure.
All right, on average.
100 minus 37.
No, I got that.
Okay.
Yeah, I understand the simple math. But if you're investing in a stock, you're saying that the risk is
high. There is risk in the stock market. Period.
Right,
yeah.
but I think we're talking about your wealth, right? Whatever wealth I have in the stock market, I want to take your example, 63% risk.
So look at this, your investments as a whole.
Sure.
Okay, not as my 401k, brokerage account, any of that. Look at everything as a whole. So out of all of your investments, I want to put about 60 to 70% in the stock market.
Right. Okay. Now. Okay.
So
gotcha.
as you get old, as you get wiser and closer to retirement, then you want to take less risk in the stock market.
Yeah, we just talked about that. That's exactly what I was talking about with the college funds. They're more aggressive when the kids are younger, and then they're more conservative as the kids get closer to graduating from high school.
It's a similar concept.
I gotcha.
So to wrap this all back up, though, 30 years ago, the lessons we learned in one sentence is what?
Well, I think it's patience. You know, if you invest in the stock market, know there's going to be ups and downs, and if you're patient, you're eventually going to see that come back.
Even if it drops 22% in one day, don't freak out.
But you see a stock go so low, and I want to put all my money in it, and I want to win big.
Yeah.
Well, that's the big part about my job is handling people's emotions.
Yeah.
You know, you have to be able to help them realize you buy low and sell high.
We're an emotional bunch.
Sure.
And we got the rule of 100. We learned it. We learned something today. Thank you.
Thanks for having me.
All right.